Right now, at this exact second, a single drone strike in the Middle East is directly responsible for a delayed hospital MRI in London and, the impending bankruptcy of a copper mine down in South America.
Yeah, which sounds completely disconnected, I know.
Right, like some conspiracy theory drawn on a whiteboard with red string, but I promise you, it is not. Today, we are looking at how a physical war is violently crashing into the AI boom, and while the collateral damage is scrambling everything we thought we knew about the global economy. Welcome, everyone, to today's deep dive.
I'm glad to be here for this one because we have a lot to get through.
We really do. Sitting on the table between us is a stack of heavy-hitting, incredibly dense financial and macroeconomic reports. We are looking at the Oppenheimer Market Strategy Report from today, July 20, 2026. We also have the latest global market updates from Fidelity and Reuters, plus some intensely detailed geopolitical and supply chain analyses. Our mission for you today is to decode what might actually be the single biggest friction point in the world right now.
Yeah, it is a massive systemic collision.
Mm-hmm.
On one side, you have this towering, almost utopian technological optimism surrounding the artificial intelligence boom. It's digital, it's fast, and it promises endless efficiency.
Right.
But on the other side, we have harsh physical world geopolitical realities. And by harsh, we are talking about a literal escalating war in the Middle East that is physically blocking the exact materials the digital world needs to survive.
Okay, let's unpack this because the sheer scale of this situation can feel, completely paralyzing when you just read the headlines.
Oh, absolutely.
You've got stock markets entering bear territory, oil prices surging, new AI models releasing, and missiles flying. It feels like four different realities happening at the exact same time, but they are really all just symptoms of the exact same underlying disease.
Which is why you need to understand the mechanics of what is happening here. This isn't just abstract Wall Street jargon that only matters to hedge fund managers.
No, not at all.
The clash between these multi-trillion-dollar tech valuations, rising global oil prices, and shifting physical supply chains is actively reshaping your daily life. It is dictating the cost of your groceries at the supermarket,
Yeah.
the safety and yield of your retirement portfolio,
Yeah.
the interest rate on your mortgage, and even, like you mentioned, whether you can get a basic medical procedure done. The digital economy and the physical economy are just violently out of sync right now.
And we are going to trace exactly how those shockwaves reach your front door. So let's dive straight into the epicenter of the physical shockwave, the geopolitical situation. Right now, we are in the 22nd week of an active, highly destructive war between the United States and Iran.
22 weeks. And just to ground this in the timeline from our sources, this all officially kicked off on February 28, 2026.
Right, earlier this year.
Exactly. The U.S. and Israel initiated a joint air campaign that they dubbed Operation Epic Fury. The stated objective at the time was to neutralize Iranian military command centers, coastal defense installations, and senior leadership in response to a long series of escalating regional tensions.
And for a brief moment this summer, it felt like the worst might actually be over. There's that mid-June ceasefire, right? A memorandum of understanding. It brought a temporary calm, but the reports indicate it completely collapsed on July 8.
Yeah, and the collapse happened because the Iranian forces made a concerted, physical move to assert hegemonic control over the Strait of Hormuz. They didn't just rattle sabers this time, they moved assets to physically lock down the water.
Wow.
Since that collapse on July 8, the situation has deteriorated at a terrifying speed. As of today, July 20, we are looking at the 9th consecutive night of intense U.S. airstrikes. Central Command is heavily targeting underground missile silos in Tabriz, as well as critical coastal surveillance and port sites.
Places like Bandar Imam Khomeini, right? And Sarak, Jask, Konarak, Chabahar.
Exactly, all the major coastal choke points. And Iran is heavily retaliating. The Islamic Revolutionary Guard Corps, specifically their navy, has deployed swarms of fast-attack speedboats. They're launching anti-ship missiles, and most critically for global trade, they are actively laying sea mines.
And laying mines just fundamentally changes the entire risk calculus for any vessel, doesn't it?
It does. They are already claiming they've hit 2 commercial tankers that tried to use an unapproved southern transit route.
Which brings a massive domestic political component into the U.S. strategy. Because before we look at the economic fallout, we really have to look at the political stamina for this conflict.
Absolutely.
But just a quick but crucial note for you listening before we get into this. We are about to discuss some highly politically charged polling data from the United States regarding the current administration's handling of this war. We want to be explicitly clear here that we're merely reporting the data exactly as it is provided in our sources, which include a recent Washington Post Ipsos poll.
Right, neutrality is essential when analyzing these markets.
Exactly. We are not taking any political sides, nor are we endorsing any viewpoints regarding President Trump's administration. We are strictly looking at this through the lens of data and how it impacts macroeconomic stability and military strategy.
So, looking at that data, the Washington Post Ipsos poll indicates that public approval of the administration's handling of this specific 22-week war is severely softening. More than half of Americans approve only somewhat. But the real statistical anomaly the analysts are pointing to is within the Republican base itself.
This was the really surprising part of the report.
It really was. Among non-MAGA Republicans, support for the handling of the war has experienced a massive, unprecedented swing. It went from a net positive 26% back in April to net negative 25% today.
I mean, that is a 51-point swing in just a few months within a specific demographic of the ruling party. A swing that violent suggests a fundamental erosion of confidence in the operational strategy.
It creates a massive political headwind. And when you combine that softening domestic support with reports from senior defense officials warning that U.S. operational capabilities are actually becoming constrained, the picture gets a lot darker.
What kind of constraints are we talking about?
The sources cite dangerously low stockpiles of air defense systems, severely depleted long-range precision munitions, and actual battle damage to regional naval assets. The military simply cannot sustain this tempo indefinitely without massive industrial replenishment, and that takes time and, obviously, capital.
All of which brings us back to the water. The Strait of Hormuz. We hear this name on the news constantly, but let's break down the physical reality of it for a second. This is a tiny, narrow choke point between the Persian Gulf and the Gulf of Oman. At its narrowest, the shipping lanes are what, only a couple of miles wide?
Yeah, barely 2 miles wide in some navigable channels.
All right, so why does a localized naval blockade in this specific stretch of water cause a global economic meltdown?
Because of the sheer, irreplaceable volume of energy that physically has to pass through that tiny strip of water just to keep the lights on in the rest of the world. Historically, the Strait of Hormuz handles 25% of the entire world's seaborne oil trade.
A quarter of the world's oil.
A quarter.
Yeah.
And furthermore, it handles 20% of the world's liquefied natural gas, or LNG. You cannot just reroute this. There are no magical pipelines with enough excess capacity to bypass the strait.
So the ships are just stuck.
Exactly. When the conflict began, maritime insurance rates didn't just tick up, they spiked 4 to 6 times their normal cost. At a certain point, the insurance premiums exceed the profit of the cargo, and transit simply halts.
Yeah, by late April, the International Maritime Organization reported 2,000 ships and 20,000 mariners were physically trapped inside the Persian Gulf.
It's a massive logistical nightmare.
A quarter of the world's oil suddenly placed behind a wall of sea mines. The sources show Brent crude, which is the global benchmark, spiked to $126 a barrel in March. It came down a bit during the brief June ceasefire, but with the July 8 collapse, it's surging past $90 again. And there are very real fears in these reports that if this escalates further, oil could hit $150 a barrel.
Which is the nightmare scenario.
Walk me through the mechanics of that. If oil hits $150, what actually breaks?
Well, at $150 a barrel, the fundamental mathematics of the global economy just break down. Oil isn't just what you put in your car. It is the foundational cost of literally everything physical. It is the diesel in the trucks that deliver your groceries, the jet fuel for global cargo, the base chemical component for the plastics in your laptop, and the asphalt on the roads.
Right.
When the base input cost of civilization doubles, inflation doesn't just rise, it cascades. Companies cannot absorb those costs, so they pass them to the consumer, which spikes inflation, which forces central banks to raise interest rates, which crushes corporate borrowing. It triggers a synchronized global recession.
And it's not just oil, it's natural gas, too. The reports detail a massive blow to the global gas supply. On March 18, an Iranian drone strike damaged Qatar's Ras Laffan industrial city. That facility isn't just a refinery, it is a crown jewel of global LNG production.
Yeah, that strike was devastating.
It knocked out 17% of Qatar's entire LNG export capacity in a single afternoon.
And the timeline to fix it is what really has the energy markets in a panic right now. You don't just patch a pipe and turn it back on. Liquefying natural gas requires cooling it to minus 260 degrees Fahrenheit.
Which requires crazy infrastructure.
Right, highly specialized, bespoke cryogenic infrastructure. The timeline to rebuild and replace the damaged components at Ras Laffan is estimated at 3 to 5 years.
Wow. 3 to 5 years.
Because of that sudden multi-year supply deficit, Asian spot LNG prices exploded by more than 140% as countries scrambled to secure whatever free molecules were left on the market.
Which led to a truly wild geopolitical irony in Europe. To avoid freezing or shutting down their heavy industries, the European Union, which has spent years aggressively sanctioning Russia over Ukraine, quietly bypassed its own political sanctions.
They had to.
Our sources show the EU bought a staggering £3 billion worth of Russian Arctic Yamal LNG between January and April. They took 91 individual cargoes, which amounted to 98% of that Russian facility's total exports.
It perfectly illustrates that when you are facing an energy cliff, necessity dictates policy. Realpolitik always wins out over political posturing when the power grid is at actual risk.
But this is where the deep dive gets incredibly strange. And honestly, this is the most fascinating part of the analysis to me. It is the Jenga effect.
Oh, the supply chain dominoes?
Exactly. The physical world is just one massive, fragile nervous system, like a Jenga tower. You pull the Strait of Hormuz block, and it doesn't just make the tower wobble, it makes completely unrelated blocks fall out. We think of the economy in categories like tech over here, healthcare over there, mining down there, but they are all violently tethered together. So let's trace these dominoes, starting with the drone strike in Qatar and, of all things, hospital MRIs.
This is a perfect example of how opaque supply chains really are. So Qatar is responsible for about 33% of the world's helium production.
Okay.
Now, helium isn't just mined from the air. It is captured as a byproduct of the natural gas liquefaction process. Qatar's gas fields happen to have a very high concentration of helium. Because the Ras Laffan LNG facility was damaged and the logistics collapsed, that helium isn't being separated and shipped.
Resulting in a global helium shortage. And liquid helium is essential for cooling the superconducting magnets inside MRI machines. So a drone strike in the Middle East literally means a hospital in London has to delay your MRI.
Exactly. And helium is also a critical inert gas used in semiconductor manufacturing. If you want to print a microchip in Taiwan, you need helium from Qatar.
Let's follow another thread. Aluminum and aerospace.
Right, so smelting aluminum requires an unbelievable amount of electricity. It's often called solid electricity. Because the Middle East has historically cheap natural gas, they have massive aluminum smelters. Bahrain's Alba smelter is the largest in the world outside of China, handling 20% of global raw aluminum exports.
If they can't get it out.
Right, because they can't get ships through the strait to export the finished metal, they've been forced to drastically cut output. Aluminum is the backbone of aerospace manufacturing, automotive parts, and basic food packaging. When Bahrain cuts output, Boeing's raw material costs surge, and eventually the price of a can of soup goes up.
And the food aspect gets even darker when you look at the fertilizer situation.
Incredibly grim. Modern agriculture is entirely dependent on synthetic fertilizers. The Gulf region produces 50% of the world's urea and 30% of its ammonia, which are the foundational building blocks of fertilizer.
So they're trapped too.
With those shipments trapped in the Persian Gulf, farmers globally cannot secure enough fertilizer for the planting season. Lower fertilizer application means lower crop yields. Lower crop yields mean a global grain shortage, which directly translates to escalating food price inflation at your local grocery store.
Man. And the absolute weirdest domino effect of all involves China, sulfur, and copper mines in Chile. You're going to have to walk me through the mechanics of how a blockade in the Middle East bankrupts a South American mine.
It's a brilliant, terrible loop. Because of the blockade, massive shipments of critical minerals, specifically sulfur, are trapped. Sulfur is a primary ingredient used to make sulfuric acid, which is one of the most vital chemicals for global industrial processes. Facing this sudden scarcity, the Chinese government enacted a strict export ban on their own domestically produced sulfuric acid just to protect their internal manufacturing base.
So they basically hoarded the acid.
Exactly. Now, who desperately needs sulfuric acid? Copper miners. Specifically, copper mining operations in Chile, halfway across the world, use massive amounts of sulfuric acid in a process called solvent extraction to leach copper from raw ore.
And they import it.
They rely heavily on importing that acid. So a war in the Middle East traps sulfur, which forces a Chinese export ban, which physically starves the Chilean copper mines of the chemicals they need to operate, crippling their output.
And we desperately need copper right now to build the data centers and the power grids for the AI boom. It's a complete physical chokehold. And just to top off the misery, let's talk about aviation. Jet fuel costs in North America rose 95%. Spirit Airlines, a major budget carrier that operates on razor-thin margins, literally ceased operations in May of 2026.
Yeah, that was a huge shock to the travel industry.
They are gone, bankrupt, because their business model physically could not survive a 95% spike in fuel input costs.
Which brings us to a massive contradiction in the data.
Right. Wait, hang on. Because if the physical economy is this badly damaged, I mean, if airlines are going bankrupt, copper mines are starved, hospitals are delaying procedures, and basic materials are in massive shortage, how is the consumer not panicking? Are we in a recession or a boom? Because I'm looking at these economic reports and they seem to describe a completely different reality.
What's fascinating here is that the physical bottlenecks and energy spikes don't always immediately crash consumer sentiment. Instead, they bleed slowly into the system, leading directly to how this geopolitical chaos is scrambling the math for central banks and creating a massive paradox in the macroeconomic data.
Let's look at the macroeconomic squeeze then. The Oppenheimer report noted that in June, both CPI, the Consumer Price Index, and PPI, the Producer Price Index, actually moderated. Inflation appeared to be slowing down. Retailers were even cutting prices to lure in consumers. The narrative just a month ago was that inflation was beat.
That was definitely the narrative. The Federal Reserve was looking at that June data, thinking they had achieved the impossible soft landing and could finally start cutting interest rates.
Right. Everyone wanted to cut.
But the July oil spike has thrown a massive wrench into the plumbing. Because energy costs act as a tax on the entire supply chain, the inflation threat has violently returned. Markets are currently pricing in a 60% chance that the Federal Reserve will actually hike rates by 25 basis points by September.
Let's clarify what that actually means. A rate hike of 25 basis points when everyone was desperate for a cut. A basis point is just 1/100th of a percentage point, so we are talking about a 0.25% increase. But why does that tiny fraction cause such terror in the markets?
Because it signals that the central bank is losing control of the narrative. It's not just the 0.25%, it's the realization that the era of cheap money is moving further away, not getting closer. Because of that fear, the yield on the 30-year U.S. Treasury bond has pushed back above the critical 5.0% barrier.
Explain the mechanism of that 5.0% barrier. Why is that specific number a nightmare?
Well, the 30-year Treasury yield is essentially the baseline cost of borrowing money over a long horizon. When the U.S. government has to pay 5% to borrow money for 30 years, it sets a floor for everyone else.
Because they're the safest borrower.
Exactly. If the risk-free government rate is 5%, a bank isn't going to give you a 30-year mortgage for less than 7 or 8%. A corporation trying to build a new factory might have to pay 9 or 10% on their corporate bonds. 5.0% is a massive psychological and mathematical threshold that makes capital incredibly expensive. It strangles economic expansion.
But this inflationary strangulation isn't happening uniformly across the globe, is it? The Fidelity reports highlight some really interesting global divergence.
Right. The U.S. is facing sticky, stubborn inflation. But look at Germany. Their producer price index actually fell 0.3% in June.
Oh.
Industrial pressures there are easing, primarily because their heavy manufacturing base has already slowed down so much. This gives the European Central Bank a little bit of breathing room, though. With oil jumping again, they are likely to hold their benchmark rate steady at 2.25% at their meeting on Thursday.
And then there's Canada. Canada's inflation slowed to 2.8% in June. If you just read the headline, it sounds like they've solved the problem entirely.
You always have to look under the hood of these statistical baskets. That drop to 2.8% was heavily driven by a massive 10.2% drop in retail gas prices during that specific month in Canada. But that headline number completely masked what the analysts are calling a localized World Cup premium.
Right, because the World Cup matches are being played across North America this summer.
Exactly. When you dig into the regional data for Ontario and British Columbia, where the actual matches are being held, traveler accommodation prices, hotels, short-term rentals, they spiked by about 20% year over year.
Right.
Rental cars and airfares accelerated massively too.
So if you were living in Toronto in June, the statistics told you inflation was 2.8%, but your actual lived experience felt like inflation was roaring.
Precisely.
And we also have to note the UK, where there's been a major political shift. Andy Burnham is coming in as the new UK Prime Minister, and Shabana Mahmood is expected to be named Chancellor. The markets are viewing this as a shift toward a much tighter fiscal stance in Britain. What does a tighter fiscal stance actually mean for global liquidity?
It means the UK government is expected to spend less borrowed money. They are likely to raise taxes or cut public spending to balance the budget. When a major economy tightens its belt like that, it pulls liquidity out of the global system, acting as a further drag on global growth, compounding the pain of the high interest rates we just discussed.
Which brings us to the contradiction I simply cannot wrap my head around, the consumer paradox. I am looking at the Conference Board data from the reports. The U.S. leading economic index, the LEI, slipped 0.2% in June. That is a negative indicator, heavily driven by weak housing permits.
Things look bad on paper.
They do. But then you turn the page, and the University of Michigan's Consumer Sentiment Index for July didn't just stay flat, it jumped from 49.5 to 54.4. And consumers' one-year inflation expectations actually fell to 4.2%. And D, on top of that, multifamily housing starts inexplicably surged 76%.
It is a genuinely dizzying set of conflicting data points.
Wait, hang on. You're going to have to explain this to me because it sounds completely disconnected from reality. How can consumer sentiment be rising to its highest level since February, and developers are suddenly breaking ground on a massive number of multifamily apartment buildings, while we are simultaneously staring down the barrel of 5% Treasury yields, a potential Fed rate hike, and skyrocketing oil because of a Middle East war? Are everyday people just completely numb to interest rates? Is there a lag effect where reality hasn't hit them yet?
That is exactly what is happening. The answer lies in where the financial pain is currently localized and the psychological lag of the consumer. The average person doesn't watch the 30-year Treasury yield on a daily basis.
Right.
They might be temporarily buoyed by summer optimism, or they've seen some wage growth, or they felt wealthy because of that brief dip in gas prices in June before the July oil spike really translated to the pump.
They look at their checking account today, not the macroeconomic yield curve.
Precisely. And regarding that 76% surge in multifamily housing starts, that is actually a symptom of the high interest rates, not a defiance of them.
Wait, how does that work?
Because 30-year mortgage rates are so painfully high, nobody can afford to buy a single-family home. Because nobody can buy, everybody has to rent. Developers see this massive trapped demand for rentals, so they are rushing to build large multifamily apartment complexes to capitalize on the entire generation of people priced out of homeownership.
Ah, so it's not a boom, it's a structural adaptation to the pain of high rates.
Yes. However, while the everyday consumer might be temporarily insulated by those lagging indicators, the corporate world is absolutely not. Specifically, the hyper-leveraged, capital-intensive technology sector is acutely, violently sensitive to 5% interest rates. A consumer might ignore a rate hike, but a multi-billion-dollar tech firm relying on cheap debt to build server farms cannot.
Here's where it gets really interesting. Let's talk about the AI bear market. Because if you looked at the projections just a month ago, analysts were modeling massive utopian earnings. FactSet put the bottom-up earnings estimates for the S&P 500 at a 23.6% year-over-year growth for Q2. I mean, that is a historically high expectation.
It is a market price for absolute flawless execution.
But flawless execution isn't happening. The technology sector is physically cracking under the weight of these expectations and these 5% interest rates. Let's look at the stats from the Fidelity and Reuters data. The Philadelphia Semiconductor Index, the SOX, has plummeted into a technical bear market. For those unfamiliar, a technical bear market means the index has dropped 20% or more from its recent high. The SOX dropped over 20% from its June 22 peak.
Though we should contextually note, as John Stoltzfus at Oppenheimer points out in his report today, even with a 20% drop, the SOX is still up roughly 65% year-to-date. The narrative isn't that semiconductor companies are worthless. The narrative is that they simply got way ahead of their skis regarding near-term valuation.
Ahead of their skis is putting it mildly. We're seeing severe drops in the major foundational players. NVIDIA was down 2.2%, Netflix down 7.3% on revenue guidance misses. And it's not just isolated to the United States. The tech-heavy South Korean Kospi index absolutely dived nearly 9% last week. Retail investors over there were facing brutal margin calls.
Let's explain what a margin call is, because it dictates how these sell-offs accelerate. When you trade on margin, you are borrowing money from your broker to buy more stock than you could afford with your own cash. The stock itself acts as the collateral for the loan.
Right.
If the stock price drops below a certain threshold, the broker calls you and demands you deposit more cash immediately to cover the risk. If you don't have the cash, the broker forcefully liquidates your stock at whatever the market price is.
Which creates a doom loop. The broker sells your stock, which drives the price down further, which triggers more margin calls for other investors, causing more forced selling.
Exactly. It squeezes leveraged positions out of the market violently. Yeah. And we have to ask the fundamental question here, why? Why, if artificial intelligence is undeniably the future of human productivity, are the creators and the hardware makers getting punished so severely right now?
Yeah, why now?
The answer is a mechanical shift that analysts are calling the enterprise software repricing.
Let's dive deep into the mechanics of that repricing. How does it actually work inside a corporation?
Imagine you are the chief financial officer of a Fortune 500 company. You have an IT budget. For the last 5 years, you spent that budget on various enterprise software subscriptions, cloud management, CRM tools, standard productivity suites. Now, your board of directors is screaming at you that you need to implement generative AI immediately or the company will become obsolete. The AI FOMO, fear of missing out, is intense.
But because interest rates are at 5% and inflation is high, the CEO isn't giving you a larger overall budget. Your pie is exactly the same size it was last year.
That is the crux of the issue. To implement AI, you have to buy incredibly expensive AI hardware. Specifically, you need the high bandwidth memory chips from companies like Micron and South Korea's SK Hynix that are required to run these massive language models locally. Because your budget is flat, the only way to buy the hardware is to cannibalize your existing software budget.
You aren't expanding the pie, you are just cutting a massive slice out of software and handing it directly to the hardware manufacturers.
Precisely. Companies are aggressively slashing their traditional software spending. We saw a stark, terrifying example of this with IBM. IBM suffered a historic 25% single-day drop in their stock price.
25%.
Right. Why did an absolute bedrock legacy tech company drop a quarter of its value in one day? Because management reported that large enterprise software contracts have completely stalled. Clients are pivoting their capital to buy memory hardware ahead of expected price hikes, leaving software companies out in the cold.
Boy, even the hardware guys, the semiconductor index dropped 20%. If the software money is flowing to hardware, why are the hardware stocks also crashing?
And that leads directly to the perspective from John Stoltzfus at Oppenheimer. He notes that investors are simply getting incredibly impatient. Wall Street has pumped trillions of dollars into AI infrastructure over the last 2 years. Now they are demanding to see immediate massive profitability and margin expansion from these investments. But Stoltzfus argues that this expectation is fundamentally unrealistic. Sizable advances in technological innovation don't come cheap, and they take time for their effect to be realized across the broader economy.
It's like the late 1990s. We laid millions of miles of fiber optic cables. The telecom companies went bankrupt doing it because it was so expensive. But a decade later, that infrastructure allowed companies like Netflix and Uber to exist.
Perfect analogy.
The infrastructure phase is capital intensive and brutal. The application phase is where the profit is. But Wall Street doesn't want to wait 10 years.
Exactly. And just to add fuel to the fire, the U.S. tech sector is suddenly looking over its shoulder at geopolitical competitors who are threatening to commoditize their primary product.
Yeah.
The reports detail a major shockwave originating from China. A Chinese firm called Moonshot AI just released an open-weight model called Kimi K3. And apparently, this Kimi K3 model is suddenly rivaling the U.S.-based Anthropic's Frontier Fable model.
Let's explain what an open weight model actually is, because this is the detail that destroys the business model. For anyone unfamiliar, an open weight model like this Kimi K3 essentially means the underlying architecture, the mathematical weights and parameters that make the AI smart, are accessible and downloadable, unlike a closed proprietary black box that OpenAI or Anthropic uses. It's like giving away the recipe instead of just selling the cake.
And that is terrifying for U.S. tech valuations. Companies like OpenAI and Anthropic are valued at tens of billions of dollars based on the premise that they have an insurmountable technological moat. They have the secret sauce, and you have to pay a monthly subscription to access it. If a Chinese firm can produce a model that achieves parity with top-tier U.S. models, and they just release the weights for anyone to use at a fraction of the cost, it implies that AI capabilities might become commoditized much faster than Wall Street anticipated.
If the smartest AI in the world is essentially free and open source, the massive profit margins that justify a multi-trillion-dollar valuation evaporate overnight. So, asking on behalf of everyone listening who is staring at their 401k wondering what to do, if AI is supposed to be the ultimate efficiency engine that transforms human labor, why is the market punishing the creators? Is this the popping of a dot-com style bubble, or is this just a healthy routine moment of taking profits before the next massive leap forward?
It's likely a painful transition period. We're moving from the hype and build phase to the prove it and monetize phase. And the prove it phase is always where the weak players are shaken out. But to answer your question about the broader market, With tech looking this wobbly and inflation running hot and a physical war in the Middle East throttling supply chains, well, capital doesn't just disappear.
No, it just moves.
The smart money has to find somewhere else to go. Investors and corporations are resorting to drastic measures right now to protect their wealth, which leads us directly to the structural shifts happening beneath the surface of the global capital markets.
If money is bleeding out of tech because of hardware costs and valuation fears, it has to go somewhere. So where are these institutions fleeing to? Let's look at the global capital and corporate shifts. The reports outline some very specific defensive maneuvers by major investment firms like Liberty International. They are pivoting hard toward companies with incredibly resilient revenue models that don't rely on hype.
Right. They're looking for financial bunkers, companies that don't rely on cheap debt or AI promises to survive.
Exactly. For example, one of their top picks is Franco-Nevada. They are a debt-free gold royalty hedge. Let's explain that business model because it's brilliant in an inflationary environment. A royalty company doesn't actually operate the gold mines, which means they don't have to worry about the rising cost of diesel fuel or labor strikes.
Which is key right now.
Right. They just provide upfront capital to the miners in exchange for a percentage of the physical gold produced over the life of the mine. So, with inflation fears returning, a completely get-free company tied directly to the price of gold is the ultimate defensive play.
Another fascinating pivot is toward companies like Halma plc. Halma makes life-saving technology, hazard detection, environmental protection. But crucially, they derive about 20% of their revenue from manufacturing optical components for data centers.
Ah, so it's a way to play the AI infrastructure boom, selling the literal picks and shovels like optical components, but without taking on the extreme valuation risk of a pure-play semiconductor designer like NVIDIA.
Exactly. You get the upside of data center expansion, anchored by the stability of hazard detection systems. And finally, they highlight Jardine Matheson, an Asian-focused conglomerate that's trading at a deep discount, offering diversified regional trade exposure with manageable debt. What Liberty International is doing by picking these specific stocks is a microcosm of the defensive scramble happening globally. Corporations are looking at the 30-year Treasury yield sitting above 5%. They're looking at a 60% chance of a Fed rate hike, and they are panicking about their own balance sheets.
Which perfectly explains the massive corporate debt issuance we saw this week. Wall Street giants, Goldman Sachs, JP Morgan Chase, Morgan Stanley, they rushed to the market to issue a combined $28 billion in corporate debt.
Which sounds crazy.
Right. On the surface, taking on debt sounds like a bad idea when rates are high. Why are they doing this?
They are desperately trying to lock in current interest rates before the Federal Reserve hikes them even further in September. If you believe the cost of borrowing is going to 6% or 7% next year, paying 5% today is actually a defensive maneuver.
Ah.
I think they're paying a premium now to guarantee their borrowing costs for the next decade. It's a defensive move disguised as an offensive capital raise. They are building a war chest of cash to weather the storm.
And while the banks are raising cash, the M&A market, mergers and acquisitions, is running into massive brick walls erected by the government. The highlight of the week in the media landscape was the dramatic freeze of the $81 billion merger between Paramount Skydance and Warner Bros. Discovery. U.S. District Judge Araceli Martinez-Olguin issued a temporary restraining order halting the entire transaction.
This is a huge signal regarding how the government views corporate consolidation right now. 12 different states sued over antitrust concerns. They argued that combining two of Hollywood's remaining 5 legacy studios, merging streaming platforms like Paramount Plus and Max, and combining CBS News with CNN would systematically reduce competition.
And more importantly, in an era of high inflation, reducing competition usually leads to raising prices for consumers. The government is hypersensitive to anything that looks like it will give corporations more pricing power over the consumer. So that $81 billion deal is completely frozen. And the mechanics of the deal dictate that if Warner Bros. Discovery doesn't close by September, Paramount incurs massive penalty costs, which tanked the stock.
And it's not just traditional media and banking in flux. Look at the crypto markets. They are hovering in total regulatory limbo right now because U.S. agencies just missed the statutory deadline for the Genius Act.
The Genius Act deadline for stablecoin rules. Let's explain why this matters. A stablecoin is a cryptocurrency designed to be pegged to a reserve asset, usually the US dollar. It's the primary mechanism people use to trade in and out of volatile cryptos like Bitcoin without having to constantly move money back to a traditional bank. The Genius Act was supposed to provide the federal regulatory framework for how these coins must be backed and audited. audited.
But the agencies missed the deadline to establish the rules. This leaves stablecoin issuers completely blind ahead of the January 2027 enforcement date. Capital absolutely hates uncertainty. When a multi-billion-dollar market doesn't know what the rules of the game will be in 6 months, institutional money simply refuses to participate. The missed deadline creates a chilling effect across the entire crypto ecosystem.
Bringing this all back to the everyday consumer, we saw a fascinating dynamic play out with Domino's Pizza this week. Domino's reported their Q2 earnings and they completely missed Wall Street estimates. They saw a 10% drop in June sales, which clearly shows that consumer discretionary spending is weakening under the weight of these high interest rates. People are tightening their belts and ordering less takeout.
But look at the market reaction.
That's the crazy part. The stock jumped 7.1% in pre-market trading. Why on earth does a stock jump when sales fall 10%? Because management promised aggressive physical expansion. They committed to building 175 new domestic locations and 800 international locations by the end of 2026. So the market completely forgave a terrible sales month because the company promised future physical footprint growth. They prioritized capital expenditure over immediate operational revenue.
Which perfectly illustrates the chaotic, almost nonsensical nature of the current market. Investors are desperate for tangible physical growth. But as wild as all these corporate maneuvers are, from Domino's Pizza to Warner Brothers, they pale in comparison to the ultimate systemic tail risk outlined in the reports.
The Japanese wildcard.
This raises an important question about the fundamental invisible plumbing of the global financial system. To understand this, we have to look at an administrative decision made in Tokyo. This week, Japan's Finance Minister Katayama made a public urge to the Government Pension Investment Fund, the GPIF, to increase their buying of domestic Japanese government bonds, or JGBs.
Wait, hang on. A pension fund in Tokyo decides to buy local Japanese bonds instead of foreign ones, and that is supposed to make a mortgage in Ohio or Manchester more expensive. You're going to have to walk me through the step-by-step math of that because it sounds completely disconnected.
It is the most important connection in global finance. The GPIF is not just any pension fund. It is the world's largest public pension fund. They manage approximately $1.8 trillion. For decades, Japan has had zero or even negative interest rates to fight off internal deflation. Because Japanese bonds paid zero yield, Japanese pension funds had to look overseas to generate returns for their retirees. So they took their hundreds of billions of dollars and bought foreign debt, primarily long-term U.S. treasuries, which paid a much higher yield.
So Japanese capital has essentially funded the U.S. national debt for a generation.
Exactly. But now, the macroeconomic winds are shifting. Inflation is returning to Japan, which means Japanese bond yields are finally rising. If the Japanese government actively directs the GPIF to repatriate that capital, meaning sell their foreign holdings and bring the money home to buy newly attractive Japanese debt, it would result in the sudden liquidation of hundreds of billions of dollars of U.S. treasuries.
A massive, unprecedented supply of U.S. bonds suddenly dumped onto the open market.
And this is where the math hits the consumer. When supply floods the market, the price of the bonds falls. And because bond prices and yields operate inversely, when the price of a bond falls, its yield goes up. So if Japan brings its money home, U.S. Treasury yields will violently skyrocket past that 5% barrier we talked about. Borrowing costs of the U.S. government will surge, which forces them to issue more debt, which drives rates higher.
And it trickles down.
Corporate borrowing costs will surge, stifling innovation. And the U.S. consumer buying a home will suddenly face mortgage rates they haven't seen in 30 years. It would force a massive, painful repricing of global equity risk across the board.
It's the Jenga tower again, but this time with sovereign debt. You pull a policy lever in a government office in Tokyo, and the cost of capital in Silicon Valley and the mortgage rate in Ohio jumps instantaneously. The fragility of this system is staggering.
The global sovereign debt market is incredibly interconnected, and this threat of Japanese capital repatriation comes at the exact moment the U.S. bond market is most vulnerable, grappling with the sticky inflation from the physical geopolitical energy shocks in the Strait of Hormuz. It's a perfect storm of macroeconomic pressure.
So, what does this all mean? We have covered a staggering amount of ground today, diving deep into the mechanics of everything from helium extraction to margin calls. If we pull all these threads together for you listening, it seems like we are standing at the precipice of the next new normal. We have a world where our digital ambitions, this incredible utopian vision of artificial intelligence transforming the nature of human labor, are running at light speed. But those digital dreams are violently crashing into physical roadblocks.
The AI boon is the brain, but it is sitting in a global economy that is essentially having a heart attack. The brain wants to run a marathon. It wants to calculate at the speed of light. But the arteries, the shipping lanes in the Middle East, the copper mines in Chile, the power grids in Europe are hopelessly clogged.
The digital world needs physical memory chips, which require physical helium from Qatar, which can't get on a physical ship because of a literal naval war in the Strait of Hormuz, which drives up physical oil prices, which causes global inflation, which forces central banks to keep interest rates punishingly high, which makes the capital required to build the AI infrastructure prohibitively expensive, which causes the tech stocks to crash. It is a perfect closed-loop storm of friction.
And that leaves us with a profound contradiction to consider. We spent the last hour discussing how physical supply chain constraints, copper shortages, and energy wars are throttling the global economy and threatening the tech boom. But as artificial intelligence continues to evolve and become more agentic, we have to ask, will these digital models eventually become smart enough to engineer their own novel solutions to our physical supply chain bottlenecks? Will AI figure out how to perfectly optimize logistics, or discover new material sciences that bypass the need for traditional copper? Or will the hard, inescapable laws of physics, the reality of needing physical metal, physical energy, and open shipping lanes, always place a hard, unbreakable ceiling on the digital revolution?
That is the trillion-dollar question for the next decade. Thank you so much for joining us on this deep dive into the sources today. We hope this helped decode some of the massive complexities driving the headlines. The global economy is murky right now, but by tracing the actual mechanics, from a drone strike in the Gulf to an export ban in China to a software budget in Silicon Valley, we can start to see how the whole machine is wired together. Keep questioning the headlines, keep looking for the physical blocks holding up the digital tower, and we will see you next time.